Thanks very much for that introduction, and hello, everybody. Yes, I'm Katie from the FT. Thank you to the ICMA for inviting me along again this year. It's always a good event. I thought that speech there from Alexia Bertrand was a really interesting insight into the reality of why it's important that markets in Europe function properly. So what we're going to do today is have a talk not about macro, where interest rates are going, which cryptocurrency to buy, none of that stuff. We're going to be talking about what the structural challenges are in Europe for markets and the policy challenges and what we might be able to do differently. So I'm joined by André Kuusvek, who is the CEO at Nordic Investment Bank, Corentine Poilvet-Clédière, whose name I was terrified of pronouncing wrong, who's the CEO at LSEG, Gaspare Sala, who's the CEO at Pictet Trading and Sales, and at the end, Mary Pieterse-Bloem, who is the CIO at Rabobank. So we've got people from lots of different parts of the financial system represented here. So what I want to do first to get the conversation going is ask each of you, what do you think is the #1 policy challenge in Europe at the moment for financial markets? André, because you're sitting next to me, you have the misfortune of having to go first.
That's okay. And it's a pleasure to be here. Thank you for inviting. I think we need to always, before we say in which direction we would need to go, figure out, look, where are we? What is the big problem? You know, we have had the climate challenge that we have been aware of now for years. We have the big split of the world between democratic free world versus autocratic and those that only know how to impose influence by force. And then finally, maybe regionally in Europe, we have a competitiveness issue as well. I think each of those can be addressed through moving the money where it is working most efficiently, i.e. capital markets. So I would say in Europe, a more integrated, more connected infrastructure, better access by all, and then finally, of course, the CMU as part of the big global capital market.
Yeah, exactly. Corentine?
Yeah, so I think we've reached a major paradox right now. I'm just going to go straight in, right? Because I mean, the main problem with Europe is that it has no scale. It has no scale right now. We have a variety of fragmented regional champions, right? And we're all conscious of the fact that we need to play to our scale, because the whole union project was to bring power and prosperity at that kind of scale in order to compete outside the union. But to do that, you need to engage in the union and actually accept consolidation in the end, in some areas, as my colleague just said. And we're obviously 2 weeks away from the European election. That was quite rightfully mentioned. I think we all know that there is still a level of, maybe more than before, skepticism in the population with regards to the union. And when that's the case, as political leaders across the countries, how do you engage in such consolidation, right? So that's a conundrum, because selling your banks, merging your FMIs and so on, which are things that would need to happen eventually to create that scale, does require some level of engagement and therefore some level of support. But equally, not doing it doesn't allow us to materialize the level of prosperity that the union promised, and that fuels the skepticism. Right. So we can unpick many of that, but I think the main problem right now is that there's no scale.
Right, interesting. Gaspare?
Yeah, so the key policy issues I would mention are centered, to put it positively, what could be improved around 2 key subjects. One is simplification of regulation, and one is harmonization of regulation. So the simplification, just to say, I'm not advocating less strict or less stringent regulation, right? We need strong regulation. Europe is known for that, and I think it's a positive. But regulation, in my humble opinion, tends to be a bit over-engineered, very, very detail-oriented, and I'm not sure that this will ultimately really strengthen the financial system. So you could put it like, you know, with all the trees, you don't see the forest anymore. And despite, you know, we are a Swiss-based group, right? And we had, as was mentioned as well this morning, we all know we had a major incident last year with the near collapse of a globally systemic bank, despite all this regulation, right? So it creates a false sense of security, I think, if we regulate very deep and every detail, and we have a procedure for everything we do, and then we miss kind of the big picture of what, you know, the real issues could be in a firm like, you know, I don't want to elaborate on the case, we've all read about it, but there could be topics of, you know, misaligned objectives, risks, fraud risk, legal risk, etc. And at some point, client trust can be lost.
Right.
And when that happens, no regulation will save you. So basically, the more overarching topics remain very, very important to observe. On the harmonization, I think Europe has obviously a pan-European regulation. We are a group, we have a European bank that is now since 1 year headquartered in Frankfurt. Previously, we were headquartered in Luxembourg. We had some strategic reasons to change the headquarters. I think we're a rare case of a European bank changing their headquarters within the Eurozone. And we are obviously not systemically important at our size, so we are under supervision of the national regulators. And we were still quite surprised as to how differently the regulation gets applied.
Just in that switch between Luxembourg and...
The switch from Luxembourg to Germany, and I leave it to you to imagine which one of the two was more stringent, but what we found is nevertheless quite a bit of remediation work that we had to do, and we were quite surprised by the different level of application. So harmonization, not just within Europe, but obviously desirably also internationally, as was mentioned as well this morning in the first panel, is very, very helpful for banks because it reduces complexity, it reduces cost, and it helps to create a real level playing field.
Yeah, interesting. Mary?
Yeah, for me it's in the area of sustainability. We have an enormous challenge facing us, and we need to mobilize a lot of capital, and we need to mobilize it fast. And I think that Europe is introducing, you know, lots of kind of like incentives, also regulation, but also incentives. It's really at the new frontier, I think, of all the continents in the world. But it's also over-engineering things a bit too much. And I give you a very concrete example in the area of green bonds. I'm a fixed income specialist, where you see regulations coming from different directions actually working against each other. For example, we have the SFDR regulation. I think lots of people are familiar with that. That is for the retail investor, and regulation for disclosure on investment funds, giving green bonds an Article 9 classification. Super good, right? So investors really desire green bonds very highly, and that's exactly what you want. On the other hand, you have the EU taxonomy introducing very, very stringent regulation on what can classify as green. So you're kind of like increasing the demand on the one hand side, and you're cutting off the supply or making supply from issuer side much more difficult. So you create a tremendous imbalance in that market. And that's a bit kind of like, you know, the EU is missing the goalposts, let's say. So I would very much agree with my previous speaker. Simplify, make sure that regulation is coherent, look at the total picture of regulation of what you are imposing on capital markets as a whole, and listen to the market practitioners for unintended side effects.
It's quite a downbeat picture, if you don't mind my saying, from all of you. What we've got is a kind of regulatory framework that's fragmented, that has certain elements that conflict with each other, and a sort of lack of coherence. I found it quite striking in, I don't know if you were there to see it, but Mary McGuinness's speech last night at the event, where she was talking about a lack of ambition, about vested interests across national governments in Europe that are holding a lot of this project back. So still waiting on clarity from national governments about what the objectives are. I mean, to your mind, what are the real impediments to getting the Capital Markets Union to become a reality? Is it ever going to become a reality? How much difference would it make? André?
Yeah, before COVID, back in 2018, 2019, I was in my previous job as head of capital market development at EBRD. I was part of that high-level forum which had been created at the initiative of the Commission to talk about the different aspects of the CMU and how to set up both the legislative regulatory side, the infrastructure, investors and issuer side. And of course now, 5 or 6 years later, I can well understand the Commissioner's speech from yesterday that, look, everybody's getting impatient. On the previous round of opinions here, this panel, it also comes through that US innovates and Europe regulates. Yeah. There are these national interests involved, but I think what is really important is to kind of keep that vertical, what I would call a value chain of money, where the capital markets is the backbone effectively going, which is that we need to cater to the needs of and the desires of the investors further up on that value chain. Big pension funds, big asset managers, even if they're not in Europe, they don't need to be. I think it's really important to also trade and move money between the different regions. That's certainly what we do as NIB, as supranational owned by 8 governments, AAA rated. 90% of our balance sheet is essentially attracted through the bond markets. Vast majority of that from outside both our home region but also Europe. And then develop products that kind of help to link that, and I think the green is very important. We've been a green bond issuer at NIB since 2011. We call it Nordic or NIB environmental bonds. It's a known product. It's a dark green being considered. We are now also, we have taken initiative through a task force within the principles with 3 other partners to basically develop sustainability-linked or bond guidelines for sustainability-linked loans, where again we can go on that green value stream, and I think eventually then channel it down to the enterprises that deliver the growth, hopefully.
I mean, Corentine, to your mind, what is going wrong here? What are the obstacles? Are you sympathetic to the view that Marie McGuinness was expressing yesterday around vested interest in national government?
Yeah, I believe she used the word like we have to take it up level basically, and think in terms of EU-wide competitiveness, which I completely agree. So if we try to slice that problem, right, because the CMU I think is creating major fatigue because it's driven by the norm. And I know it's going to be utterly ironic because I'm actually a clearinghouse, but I will advocate in favor of a bit more risk appetite into the whole system. Because risk has to be managed, but risk has got to exist in the system to some degree. Because risk is what? Risk is taking on something that's not been done before. So if you don't want risk, you will follow the whole time something that somebody else has done before you, and might not even be the right solution. I mean, to your point, the regulations are so prescriptive that we care a lot more about being by-the-book compliant than whether it's achieving the risk coverage that it's meant to achieve. So a bit of risk appetite, fundamental in the system. Result-oriented text. Result-oriented text with basically ex-post inspection on site. Is it covering the risk? Yes, no. That kind of level of confidence. We need European champions that actually compete outside the European Union. I completely agree with you. I mean, you want to have US investors, you want to have Japanese banks joining, you want to have Canada. I mean, in LCH that I run out of Paris, in our fixed income service, the first things we worked on for the euro-denominated pool over the first 2 years was to get top banks from Canada, Japan, Australia, and so on. Why is that? A, they're interested in euros. That's great. Makes everybody in the Eurozone richer. We should always remember that, right? It's good. You want to be a reserve and an exchange currency. And B, they don't have the same economic cycle and or accounting season. So when you are bringing them in a liquidity pool, you want that diversity of behavior because it stabilizes the pool. So it's almost like we need to remember, right, that fair competition, frictional competition, but on level playing field, to your point. Openness, attracting the clients, that is basically supposed to push us to quality. And it's almost like right now it's all about control and no risk. So we seem to be more content to have not so good but very well controlled entities. I'd rather have excellent and kind of shared entities, and I think we can still control them. We just have to remember that sovereignty has power and scale in it. So I would encourage us to focus on that. And the last point I'll make is just slightly outside post-trade, but it was touched on by Secretary Bertrand. Where are the savings going, right? I mean, we know that structural problems, that obviously the EU is very, very primarily bank-driven, which puts a tremendous pressure on the banks, by the way, which really struggle to comply with everything and intermediate. But where is the rest of the saving? Obviously, we're talking CMU here. I was reading some very interesting stats in the train, actually, that the savings stays very, very national. It's about 80% of the French population, for example, when they invest outside their own saving accounts, they invest in France. 77 of the people in Germany, 60 in Spain, you name it, basically. So there's one very good idea that I will steal from the rapport Noyer on CMU that was published a few weeks ago. For those who have not read it, it's actually a very pragmatic approach that I like. They're just proposing this one simple measure is to have a saving pan-European product available to retail consumers, right? Just that. It's very feasible. And that could already sort of channel actual money to CMU, right? So I'll just finish on saying CMU has got to be money flowing around in order to finance reasonable risk-taking. And then you put some rules around it, but the rules are not the CMU, right? It's important we remember that.
Yeah. It strikes me that the European Union and the UK, for that matter, are less good than the US at seeing financial market strength as a strategic and geopolitical strength. We sort of struggle sometimes to see it as such an important part of defense of the green transition. And so that's why this stuff matters. It's not just about the functioning of markets in and of itself. It is a broader goal. But I mean, Gaspare, are you sympathetic to that view that we need more risk-taking and a greater sense of kind of confidence? And one of the phrases that people bring up with regards to, for example, bank regulation within the EU is that we're going to end up with very well-regulated graveyards, right? Is that too harsh?
Well, hopefully it's too harsh. We don't want to be in a graveyard. But yes, I agree. We need to make room for sound risk-taking. I mean, no risk, no return. Textbook, first page, right? So if we create a very safe system where banks are no longer willing to take risk, then clearly the markets will not be well functioning. Right.
Is there not an argument, actually, you raised the Swiss banking crisis that we had last year. It's amazing that it was so recent and yet the world is still turning on its axis. Is that not proof that actually the system works?
Well, somehow yes, somehow no. I mean, I think it was a shock, clearly, and unforeseen for many, including myself. I would not have thought in 2021 that this would happen, or even in 2022. But it shows, again, that strict regulation is probably not the answer to it all. And even if we come up with even better and deeper regulation and stricter metrics to respect, that is no guarantee that something like this will never happen again.
Right.
And probably that's not even the objective. To your point, I think risk-taking is important. And maybe we need better provisions to let banks fail, because in this case, it would not have been possible realistically. That's why the solution that was taken was actually put in place, because I think it would have been a disaster, frankly. So maybe on that side, there's more work required, but we need to create room for risk-taking, otherwise we will not have competitive markets.
Mary, I'll come to you in a minute, but Andre's obviously got something burning on his mind here.
I think it's really important that we have different players in the marketplace, of different risk appetite, of different maturity and duration of the investment horizon. Only then you get things going. And you cannot regulate everybody to the exact same point. Right. And you can never regulate the risk completely away. I think a lot of it needs to be that you need diversity in the market, you need many different players, and then you need to live with the fact that every now and then there is a little bit of a stress, and then the market will do what the market needs to do, and the regulators will do what the regulators need to do.
Mary, take more risk.
Yeah, taking risk. We need to accept the fact that markets are better at risk distribution probably than the government is. And I think that post the global financial crisis, we've entered into an era where government is, tried to overreach, I think, in my opinion, with regulation and indeed trying to take the risk out of the financial market system altogether. And then you get some very perverse situations. So for example, to Corentine's point on the savings. Yep. I come from a country of savers, which is the Netherlands. And I work for a bank that offers savings products and we offer investment products. Savings is not very heavily regulated, but investments are. So we want to, as a bank, but we also think that it's in the interest of the country that we move some of the savings to the investments, because with savings, people cannot cater for their own pensionable age, right? We have very, very well-filled pension pots, but even with our very well-filled pension pots, we're not going to hack it. So we do need to move some of that savings now, especially for the younger people, to investments. Okay, so what do we then do? We offer them, we try to entice them into savings. We offer them 50 euros, 100 euros, start a savings account. But then come the disclaimers. With investments, you can lose all of your money. We need to ask them 20 different questions when they want to open up a discretionary investment account. It's very perverse. So the regulation, as soon as it becomes risky, the regulation becomes very heavy and dense. And now it's, on top of that, is layered a whole, thick cover of regulation with anything that has to do with sustainable. So people want to do good with their investments, but as soon as, the word green or sustainable or impact shows up, a whole, a whole book filled with regulation shows up, and people back off. And so they say, okay, so my product, so you guess what? It's not green. Forget about green. And that's, I think, the perverse incentives that are being created with regulation. And it's such a shame, because we all know, even here, I think in Brussels, but also the national governments, people within the financial industry, we know what needs to happen. And it's very easy, can be done very easily with very simple measures.
But how do we get there, right? How do we unlock this?
Yeah, because your point about hypercomplexity, I think we have to. It's very, very true. But the hypercomplexity is the result of political compromises on text, right? Usually.
Right.
So the big real problem is if we go for result-oriented, as we seem to all be calling for, which is very interesting, because different industry, different geographies, same experience. But that sort of result-oriented, scalable way of protecting, if we should use that word, the market, it only comes with a level of trust, because you still want to operate in level playing field, at least across the European Union, but you don't want to regulate each and every line of what each and every institution is going to do. So the recent EMIR text calls for single supervisory body, at least for certain, exactly to your point, keep the diversity, nobody should have to go through the same lens. But those European champions across the sector that tend to reach at least across the union or beyond, perhaps they need that single supervisory body so they can go quicker or in a more streamlined fashion when they're competing against Japan or the US, whatever. But then you go back to fundamental question. Who's going to pay for that? Who's going to pay for that? Then if it goes bust, who's going to pay for the bankruptcy of that? And so on. And I think now is the time where we have to, well, maybe post 9th of June, but we have to invest in those really strong steps to allow at least maybe those sort of outreaching champions to get that streamlining. And then we have to build proportionality for the other guys, right? Exactly. Right. Exactly to André's point, you want to keep that diversity. But it's really important we engage in it, because right now we feel that, and we see that in every market, like we are so internally focused in between EU countries. The world is definitely moving. And there's a bit of skepticism as to the sense of speed that we can actually deliver in the union. And the cost of not moving at speed is always underestimated, in my view.
I mean, where you do see a lot of speed and innovation is, as we've alluded to, in the US,
Yeah.
where, you know, private credit markets, for example, have just exploded in popularity, and Europe is about 10 years behind in terms of the scale of private credit, and where you just have much more vibrant retail participation in markets, and where you have much more vibrant primary markets. I mean, André, what can we borrow from the US and pretend was our idea all along? What's the, what are the best policies or just ways of thinking that we need to borrow?
Yeah, we all know about the 80-20, 20-80, you know, Europe, 20% capital markets, 80% bank-dominated markets. I don't personally see there being a need to worry too much about it. I mean, if you speak to the CEOs of the big American banks, they basically say, look, it's actually wonderful to, you know, make some income without booking an asset or booking risk in the balance sheet. You know, who are the arrangers of the bond issues? Who are the ones advising? You know, who are the ones taking the fees of the trades, etc.? These are the banks. And I think that kind of a much closer integration is something that I see as is eventually, hopefully, happening in Europe, where the banks worry less about, look, at deposit here, loan there, but rather, you know, a more developed market as a whole, and then, you know, bigger income from other sources other than net interest income.
Right, right. Mary, what are your thoughts here, particularly around the sort of structural significance now of private markets in the US?
Yeah.
What are the sort of advantages and disadvantages of that sort of approach? What should we be borrowing or what should we be avoiding?
Well, I do think that with the development of private credit, and you know, I must say that a major push is also happening here in Europe to bring private credit to retail investors, for instance. One has to be very transparent about the risks involved, right? It's not the same for everybody. So I do think that you need to regulate where you need to regulate, but don't regulate more than what you strictly need to do in order to keep kind of like the show on the road. So I do think that what we can borrow from the United States is principally also a mindset, is what you were saying. So the mindset should be, we need to shift from distrust to trust and put more trust back into markets, I think. We need to shift back more to laissez-faire, not entirely laissez-faire, but somewhat more laissez-faire. And I think we also need to shift back to kind of like really have a look at what regulation is effective and bringing about the desired results and cut away the rest. So we need to go towards the real need to have and do away with, I think, the nice to have.
In the UK, my impression is that when financial institutions make that kind of argument, the pushback from the politicians is always, well, the banks would say that, and you know, the pension funds would say that, and there's this idea that you're kind of, the whole industry is still on the naughty step after the financial crisis, and that sometimes some of these types of arguments are not taken seriously because they're seen as special pleading. You know, are we at the point now where we can move past that, do you think, André? Are you able to press the case for financial services?
Yeah, I think what you're referring to is basically the first injection of distrust at the higher level. Now, as an IFI, an unregulated bank as we are, you know, I may be not the best person to talk about that, but I certainly see also within my own institution how, you know, it's a lot more important to talk about risk culture and taking risks and structuring them in a way that we can accept them, rather than, you know, having a rule book where, you know, it's either black or white and it's either go or no go.
Yeah.
So I think, you know, I've been trying to develop a structure whereby the treasury tigers and the lending lions and the risk rhinos can live with each other.
Right. Okay. You know, a happy zoo of financial markets. Yeah, Corentine, what are your thoughts there?
A couple of things. I genuinely don't think we need to look at the US, but we don't need to become the US, right? Because I mean, it's also a jurisdiction that has its own flows, right? So if if we look at the actual fundamentals of the EU on average, they're so healthy in terms of education level. Demography is better than elsewhere for most part. Healthcare system, but that's also why people don't invest in equities, right? But pretty strong in most countries, even though you have deficits. But some of these things are seen by investors, and even the union is seen by investors, because you see that when you have certain national elections like we've had over the last years, the cost of debt of those countries does not go to the roof. It doesn't, because somehow there is this international investment community that does see those fundamentals and the unions, and I think we have to pause, recognize that, take some pride in this, because we're also very good at whipping ourselves here in the EU. But we're doing some of these things very well. But definitely the world is waiting for that size, that 450 million people brought together somehow. Because if we keep most of the fundamentals, inject a tiny bit of risk-taking into the system, a tiny bit of, okay, every now and then someone's going to fail, and so be it, but we're not going to take taxpayers' money, so it's okay to let them fail. Yeah. Inject a little bit of that, then you can be scalable and successful in your own way, because exactly also to André's point, the market is diverse and the investors are diverse, and some people are very, very positively skewed towards the EU, right? Right. So I think we cherry pick what we like. What is remarkable with the US is the speed of recovery. Well, it's almost like fails fast, recover fast. Speed is great. They know how to do speed. Yeah. That's great. They do speed and do scale. We need to get a bit more speed, a bit more scale. But our fundamentals, our diversity, our regional specialization, the fact that you have much more pensioners in Northern Europe, much less elsewhere, that's a strength actually, because you get all these different curves within the same union for investors. Yeah. And typically having run the euro-denominated Repo-Clédière pooling for 5 years, that diversity of the union is something that especially non-EU-based investors love. Yeah. Because they feel like if their risk appetite has to shift, they will always find what they need within the European Union. Yeah. And that's something we need also to remember. It's just cherry pick what we need, but we don't need to mirror the US. Yeah.
So to wrap up the discussion, I'm going to ask you all, what is your number one ask from the EU? What's the one thing you would really like that would improve your lives and your business? Mary, I'll go to you first.
I think we would benefit greatly from just having one regulator, for instance, and not a regulator that sits in Brussels, creates all sorts of rules, and then disperses it to national regulators who take their own interpretation. And however much I love the AFM, which is based in Amsterdam, please create one central regulator in Europe.
That's a good item for the wish list. Gaspare?
Well, for me, being a bit of an outsider sitting in Switzerland, right? But we are very, very close to the EU, like other countries as well, like the UK. Yeah. For me, it's the biggest ask is to have a strong Europe. I think Europe has come a tremendous way. It's amazing what the EU has achieved over the last 4 or 5 decades, but way more can be done, should be done, to be a real competitor, so to speak, against the US, as we were talking about it before. It takes more unification, right? We were talking about capital markets union, but it takes also some concessions that I guess the different member states have to be willing to make, to give up some of their sovereignty in favor of the union. I mean, these are big words. It's easier said than done. We all know the challenges. Yeah. And the necessity has to be seen. I think everybody knows it, but it's difficult to move ahead. What we observe is also that, every crisis that happens, we move a step closer, right? Yeah. And that is actually the positive outcome of crisis. So, yeah, the biggest ask is more unification and creating a really strong Europe as a counterweight, to other geopolitical challengers. That would be, because I think we are all interested in having a strong Europe.
Corentine?
It's very much the same. I mean, engage in that union, just sort of really engage financially in that union, and maybe just really find sovereignty is not local control, it's scalable power. Right. So that would be good.
And I would say, I would come back what I started with, the connectivity and the access to different markets. We need to recognize that the EU markets or European markets generally are of different sizes. I think it's really important that we also build regional capital markets, because the smaller markets will always be a little bit less attractive. But you can combine things. Take the MSCI Baltic Index, for instance, that was created last year. That's a great venue to kind of, hey, now there is an index, right? There could be an instrument then that enables to invest also, into smaller markets.
Yeah, good stuff. I think we've put the world to rights, so please join me in thanking the panelists for their thoughts.